All right, what's going on, everyone? In this video, I'm going to be going over SMTs and equilibrium. I use these two things as confluences in my strategy. So I use them to tell me whether the trade I'm going to take is higher probability or lower probability. And that's something I'm going to go into in this video. So the first concept I want to talk about is called SMT. SMT, which stands for Smart Money Technique. Now, what is an SMT? Well, an SMT is basically when you have a divergence. Let me remove this. When you have a divergence between two different indices. What does that mean? Well, when you trade futures, there's two markets you mainly want to focus on, which is NQ, NASDAQ, and ES, which is the S&P 500, right? Now, I do not trade ES because price action is different in ES and contract sizes are different, so you also have to worry about that. I only use ES as a confluence for SMT. Now, I'll go into why does this start like this. All right, I got it to work. Now, how are you going to be using this different ticker, right? ES as a confluence to help you trade in NQ? Well, what an SMT is basically whenever, actually, let me first do bullish. So let's say in NQ, the chart looks something like this. ES, I'll do, this is NQ. And then this is going to be ES. All right. Now, what do you see different here? Well, in the chart I drew out for NQ, you can see that this low was taken, right? This low right here was taken. But at the exact same time, this low on ES wasn't. Now, why would that matter? Well, because these two tickers are correlated with each other, right? They trade in the same pattern, in the same way. So whenever this happens, this is what's called an SMT. Now, this is a bullish SMT. Whenever ES does not sweep the low, but NQ does. And a way I kind of like thinking about this is think of ES as a fortune teller, right? So if you see this happen in ES, that's going to make you think that NQ would want to go higher, right? But now, obviously, not all of the time is this going to work. This is just a confluence to add to your strategy. And the way you would use this is, for example, like at this point, I have no idea, right? At this point, I have no idea that it's going to keep going higher. But if I were to see an inverse fair value gap happen right here, then that would confirm to me that we are going higher, right? And this is just a confluence that helps me with that confirmation. So let's say right here, it reverses a gap. And it closes above it. And we have an SMT. Then that tells me most likely it's going to go higher, right? Because in ES, which is the fortune teller, it's already higher, right? I didn't sweep this low. This is a confirmation that it's a confluence that it wants to go higher. But I can only be certain of this if I see my strategy play out, right? Because this strategy confirms the bias on whether I'm right or wrong. And my bias is bullish here. That can only be confirmed by whatever strategy you have, by it happening. So let me show you guys an example in the charts. All right, this is a good example to show you guys. What I'm going to show you is going to be a bullish SMT. So as you can see, on NQ, we have this low and it gets swept, right? This low right here, and as we see, it comes down and sweeps it. Now, at the exact same time, what does ES do, right? Which is supposed to be the fortune teller. It does not sweep this low. Hold on. It does not sweep it, right? So once I see an SMT form, the only way I can know if it's valid is if I see my strategy play out for it to confirm that we're going to go up. And as you guys can see here, I zoom in, where did it just take me to? All right, right here. That's still not clean enough. I want to find a valid entry to validate this SMT. Let's see if I find the 3-minute. Oh yeah, this is good enough on 3-minute. So as we could see, a fair value gap gets formed right here, right? 3-minute fair value gap. And what tells me that SMT is going to work, right? What tells me that ES is being a fortune teller and saying, hey, we didn't sweep that low, we want to go higher, right? I see my strategy play out. My strategy is inverse fair value gaps. So I see that in the 3-minute, it broke above it. So now that tells me, okay, we're most likely going to go up. And what do? We rally all the way up right here and take out these highs. And we do the same thing here. All right, now I found one. I found an SMT to the downside, right? A bearish SMT. A bearish SMT is basically same thing, but just upside down. So it's when you see NQ, right, takes out a high, but at the same time, ES does not take out that same high. So what would I be waiting for it to tell me that ES is being a fortune teller, right? I need to wait for my strategy to play out. And here, as you can see, on the 5-minute, you can probably find something lower, but I'll just stick with the 5-minute now. A gap gets formed. It breaks, right? It breaks the gap. It closes below the gap. And now that's what tells me that odds are it's going to go down, right? Because before this, like at this point, I have no idea if the market's going to go down or not, right? Because an SMT is only valid once it gets confirmed by your strategy. So at this point, even if I see this, even if I see that NQ took out the high, but ES didn't, right? I have no idea that that we're gonna go down because I still haven't seen my strategy play out. But if I wait, so at this point I'm looking now, I'm waiting. Okay, let's see. Boom, close under. right here. And what would you do? That's where you would enter. Now, what I don't want you guys to get confused is I don't use SMTs in every single one of my trades. I know some people that do. I know some people that say they can't take a trade if there isn't an SMT, but that's not something I do. I use these, right? I use what I just taught you as a confluence, as something that confirms my bias more, right? So if I were to enter in a trade and I see my strategy play out perfectly, and on top of that, I see there's an SMT, I might size a little heavier, right? I might risk more because this creates higher odds for me to win this trade, right? Like the odds, once this SMT is formed and this happens, the odds of me losing this trade are low, right? And if I were to lose it, it'd be a good loss because I'd have all my confluences. So I don't use SMTs, like it's not required every single trade I take. But I am aware of them because if I do see one play out, then that makes me more comfortable with sizing heavier, right? With buying more contracts or selling, with risking more. And that's what I want to teach you guys with this. Like, I don't want you guys to get confused and think you need to use it for every single trade. You don't. It's more of a confluence you see that makes you more comfortable to risk more. That's basically it. All right, the second confluence I'll go over is called equilibrium. Now, what is equilibrium? Well, it's basically halfway point from either a low to a high or a high to a low. Now, let me show you guys what that looks like. So let's say here, make low, and we make high. And then here, we're here, make the high, and then make the low. Now, imagine this was in the chart, candlesticks. I would go to the left, look for the fib retracement tool. And I would use it. I would start at the bottom, drag it all the way to the top. Now yours is going to look a little different. All you want to do is go to settings right here and basically uncheck everything but 0, 0.5, and 1. That's all you need, 0, 0.5, 1. Now, what is equilibrium? Well, equilibrium is basically a range that tells you whether you're premium or discount. So all equilibrium is just probability. So whenever you're looking for longs, you don't want to long all the way up here because you're already so close to the high. If your bias is truly bullish, you want to be looking for longs once this comes down and dips under the range, right? Because now you're longing at a discounted price. You're longing at a point where it's better for you. Your risk reward is better, right? Because let's say you were taking a long all the way up here, then your profit target should be that high, right? Because after that, you don't know if it's going to keep going higher. Market might just be fine with taking that high and then go lower. But if you're looking for longs in this example, you'd first want for the market to come down, retrace into this 0.5, right, in the middle of the range, and that's where you would be looking for longs because the risk reward is so much better, right? The high is so much further away, and that's where you want to be targeting, the highs. So this just plays out much better. And now I don't use this like mandatory in all of my trades. As I said before, this is more of a probability. So this allows me to size more. Now, and like not all of my trades am I going to take once it comes down and is in the discounted price, right? It's below the 0.5, below the midway point of the range. There could be some times where I see my setup play out here, right? I see an inverse value gap, and I take it all the way up here. But what this tells me is that by me taking this trade, I go into the trade knowing that it's a little bit less probability, right? Because I am high up in the range. And I do accept the fact that my risk to reward is going to be less. Now, if I'm looking for longs, right, if my bias is bullish, if market retraces down to this 0.5, dips below it, then I would be more comfortable with sizing more, with risking more, because I know that my risk to reward is going to be much better because we're further from those highs. The same thing on the downside. When you're looking for shorts, you typically wouldn't want to be looking for shorts all the way down here because you're already so close to that low, right? And what does market do when it sweeps highs and lows? It usually reverses, right? If it's major points of liquidity. But you don't know that. So you're better off waiting for it to retrace back up, and then you want to be looking for shorts, right? Because if your bias is bearish, you think it's going to go lower, you'd rather look for shorts here where, hold on, let me change this, short position. You'd rather be looking for shorts here where your risk to reward is much better, right? Than if you were looking for shorts all the way down here where your risk to reward isn't that great. Now, as I said, this isn't mandatory for all of my trades, but it is something that lets me be more comfortable with risking more, right? So whenever I see this happen, where it goes up in the range, right, it dips into that discount, I'm more comfortable with risking more because I have a better risk to reward, and this is just a confluence that tells me that market is just retracing back to the 0.5 and is going to keep going lower. But that's only after I see my strategy play out, right? I'm not going to take a short. Like, I'm not going to take a short if market just comes back to this 0.5. Like, that'd be stupid. Because if I don't see my strategy play out, then I don't really know if market's going to keep going lower, right? It just could keep going higher. I need to wait for my strategy to play out. Say it forms a fair value gap right there. Boom. Closes below it. That's when I would enter, right? I wouldn't enter off the retracement to the middle of the range. That makes no sense. I would always wait for my strategy. And it's the same thing with SMTs. None of these are valid until you see your strategy play out, right? And then all these do is it allows you to size heavier, to be more comfortable with risking more because the trades are higher probability. All right, hopefully you guys understood those two concepts. In the next video, I am going to be going over my personal strategy, which is IFVGs, and showing you guys multiple examples of them. I'll be showing you guys how I take IFVGs after liquidity sweep, SMTs, Equilibrium. It is going to be a long video, but it's going to go over everything. And that's going to be my next video. So hopefully you guys enjoyed this one, understood the concepts, and I'll see you guys in the next one.